On March 18, 2026, General Mills reported fiscal Q3 earnings from Golden Valley, Minnesota. Adjusted gross margin fell 280 basis points year over year to 30.6%. Adjusted EPS hit $1.64, missing the $1.73 consensus by 12.3%. Adjusted operating profit dropped 32% in constant currency to $547 million. The stock slid to $38.50 in pre-market trading on March 19th, settling near its 52-week low of $38.59. What does a cereal company's quarterly report have to do with Federal Reserve policy? General Mills' gross margin functions as a real-time inflation gauge. When input costs for grain, packaging, and transportation spike, they hit General Mills' cost of goods sold within weeks. The Bureau of Labor Statistics will not capture those same increases in the Consumer Price Index for another 60 to 90 days. The cereal aisle prices inflation before the government measures it. The Q3 fiscal 2026 numbers map the margin erosion across General Mills' portfolio. Net sales fell 8% year over year to $4.4 billion. Organic net sales, stripping out divestitures and currency effects, declined 3%. Pound volume dropped across both the North America retail and international segments. Price and mix moved unfavorably as U.S. consumers resisted increases at the shelf. Adjusted operating profit margin contracted 420 basis points to 12.3%. CFO Kofi Bruce attributed the gross margin compression on the March 18th earnings call directly to higher input costs. Grains, oils, packaging materials, and transportation all moved against General Mills during the quarter. 9-month operating cash flow fell to $1.6 billion from $2.3 billion prior year. A $1.0 billion pre-tax gain from divesting the North American yogurt business propped up headline figures, but the underlying cash generation deteriorated beneath it. Zacks analysts covering General Mills expected gross margin to contract 140 basis points in Q3. The actual result was 280. Double the forecast. That 140 basis point gap between Wall Street's inflation estimate and General Mills' actual factory floor costs in Cedar Rapids and Buffalo is the distance between lagged economic models and real-time supply chain data. General Mills purchases wheat, corn, oats, sugar, and vegetable oils at market prices. Those inputs flow through cost of goods sold within 30 to 60 days of purchase. When commodity costs spike, the compression appears in that quarter's gross margin before the company can raise shelf prices at Walmart, Kroger, and Target. CPI surveys retail prices at the end of this chain. By the time a box of Cheerios costs more in an Ohio grocery store, General Mills absorbed the input increase months earlier in Minnesota. The margin registers the shock first. The index registers it last. The Consumer Price Index is constructed from a fixed basket of goods surveyed monthly by the Bureau of Labor Statistics. Field agents visit roughly 6,000 housing units and 22,000 retail establishments across 75 urban areas in the United States. They record prices, compile the data, and publish the index approximately 2 weeks after the survey month closes. This methodology builds in structural lag. When wheat futures spike in February, the cost increase hits General Mills' cost of goods sold by March. General Mills reports it in the next quarterly earnings. But BLS field agents will not record the higher shelf price until the increase passes through distribution, reaches store shelves, and appears in the next monthly survey. That supply chain pass-through takes 60 to 90 days from the initial commodity move to the retail shelf. Food company gross margins capture the input spike in real time. CPI captures the consumer-facing result months later. The margin at General Mills compresses first. The CPI food index follows. The 2022 episode demonstrates the lead-lag relationship. Russia invaded Ukraine in February 2022. Wheat prices doubled in 3 weeks on the Chicago Board of Trade. General Mills' gross margin compressed over 400 basis points across fiscal 2022, with the damage visible in quarterly earnings by May. CPI's Food at Home Index did not peak until August 22, when it reached 13.5% year over year. General Mills' margin compression preceded the CPI food spike by approximately 3 months. The earnings reports showed the inflation wave forming. The Fed, watching CPI from Washington, saw it later. The same pattern appeared in reverse during 2023. General Mills' gross margin began recovering in fiscal Q2 2023 as commodity costs moderated. CPI's food-at-home index did not begin decelerating until Q3 23, roughly 2 to 3 months afterward. The margin at General Mills turned first, CPI followed by the fall. The leading indicator worked in both directions. General Mills' March 18th headline numbers contained a distortion that obscures the inflation signal for anyone reading only the summary. Reported 9-month operating profit rose 6% to $3.0 billion, with operating margin expanding 280 basis points to 21.6%. Those figures include the $1.0 billion pre-tax gain from the North American yogurt divestiture. Strip that gain out and the picture inverts. Adjusted 9-month operating profit fell 23% to $2.1 billion. Adjusted operating margin dropped 310 basis points to 15.2%. Adjusted diluted EPS for the 9-month period declined 25% to $2.60. The gap between reported and adjusted operating margin is 640 basis points. That divergence matters for inflation analysis. Anyone reading the headline margin expansion as evidence that food cost pressures are easing would reach precisely the wrong conclusion. The adjusted figures contain the inflation signal. The reported figures, inflated by a one-time divestiture gain, mask it. General Mills' 280 basis point gross margin compression in Q3 fiscal 2026 signals that grocery input costs accelerated through December 2025, January, and February 2026. Those cost increases are now moving through distribution chains toward retail shelves across the United States. CPI's food-at-home component for February 2026 has been published. March and April readings have not. Based on the lead-lag pattern documented across 2022, 2023, and 2024, the margin compression General Mills reported this week should appear in CPI's food-at-home index by May or June 2026. VP of Investor Relations Jeff Seaman hosted the March 18th webcast from Golden Valley. General Mills reaffirmed its full-year fiscal 2026 outlook despite margin pressure. The company expects pricing actions to offset input costs within 1 to 2 quarters. Those pricing actions, when they reach Kroger and Walmart shelves, are exactly what CPI field agents will eventually record. The margin told you in March. CPI will confirm it by summer. Subscribe to the Ledger for the leading indicators inside earnings reports, the inflation signals the Fed ignores, and the numbers that move before CPI does.